So the market took a massive nosedive after NVIDIA earnings, and I don't think the pain is quite over just yet. So I'm going to talk about exactly what I'm doing going forward, a big hedge that I put on in the portfolio. In fact, the first hedge that I put on since starting this YouTube channel. And I'm also going to talk about a bullish position that's getting very close to entry that I will be taking as well. So let's go ahead and dive right into it. Remember, this is not financial advice. I'm just sharing what I'm personally doing for educational purposes only. Results may vary. Now, if we take a look at the portfolio, as you could see, in the past month, we're only down about 3%. Now, from all-time highs, the max in this portfolio was 1.453. Now, if you want to see me hit my 8-figure goal in this portfolio, make sure to be subscribed to the channel. If you aren't already, the subscribe button is down below this video. Also, if you get any value out of this video, please hit the thumbs up button for me. I greatly appreciate it. And I appreciate you being here, okay? So not too bad on the portfolio, primarily because I am selling options and I don't own a lot of shares. Well, I did get assigned some shares and we'll go over that, but mainly because I'm not getting one-for-one exposure with shares. So realized gain lost for the current month is about 20K. All right, now results vary month to month, year to year, but I'm not the only one doing it. As you can see here in my private mastermind, Options Trading University, we now have 639 members all sharing their inspiration here. As you can see, even on down days, right, we're still able to close out trades and share our inspiration. So it's wonderful seeing that. Now, if you do want help navigating these volatile markets to feel more at peace of mind, like me and my clients, and you want access to my Ryan's trades and leaps entries and exits, that'll be at the top of the description down below. Also, if you want my free trade ideas, that'll be on my Instagram, my X account, and my free newsletter, which are all three down below in the description. I will be sending out a newsletter this weekend, so be sure to be subscribed to all three of those. Now, let's go ahead and jump into it. What exactly happened and what is spurring this downturn? Actually, there's a lot of talk on CNBC and all of these news outlets, but no one is really getting down to the real bulk of it. So let's go ahead and dive into it. I'm going to share with you my theory of what could be leading to the short-term meltdown, okay? So again, tech stocks set for a big losing week as AI names got rocked after NVIDIA earnings. So NVIDIA was a wonderful play. We had a lot of cash secured puts. We were able to I closed out the whole position, which was like 180K of cash secured puts. And that freed up a lot of cash, but I didn't go ahead and put on a lot of trades because NVIDIA spiked up and then started melting downwards, and the whole market looked like the whole market was melting downwards. Now, let's talk about why exactly this is happening. Well, number one is key inflation data won't be presented by the next rate decision, okay? So the BLS cancels October core CPI data, inflation data, and the market does not like uncertainty. The market wants to see that, hey, data's coming out. Are rate cuts still on the way? Are they still underway? And that really shook up the markets, okay? Because the probabilities yesterday for a rate cut went from, hey, we might be having one, above 55% in December, to we're definitely not getting a rate cut. And the market didn't like that because the market was pricing in a potential rate cut for December, which would lower interest rates, which is good for businesses and consumers because they could borrow and spend more, and that money then flows into assets like the stock market. So because we didn't see that, that was a major issue. Now, there's another small thing brewing that I believe is leading to this downturn, and this is just my theory, but it definitely could be leading to it, okay? Because the last time this happened, we didn't know until it was pretty much the bottom of the crash. So basically JP Morgan, and this is an old article, this is actually from last August 2024, okay? And if you don't remember, we had a 15% crash in QQQ, which was the Japanese yen carry trade. So JP Morgan says that the carry trade that pummeled markets is only half done. So JP Morgan analysts actually expected that only half of the trade was unwound. So what exactly happened during this Japanese yen carry trade crash? It was a pretty extreme one. VIX spiked up above 60, which we hadn't seen since COVID. If you look back at the VIX, okay, this right here, this big VIX spike was during that Japanese yen carry trade. So, why could it be similar? Well, let's just take a look. The market pummeled, got pummeled by 16% and then rallied for a good 7 months. And then tariffs crash. Well, tariffs crash, obviously went down about 25%, rallied for 7 months, and then look what's happening again. So, basically what happened is banks were borrowing Japanese yen, converting it to US dollars, and purchasing treasury bonds, stocks, right, to get a bigger yield. They're borrowing yen for near 0% back in the, back for a lot of history. If you look back, the 10-year treasury or the 10-year yields on the Japanese government bonds were near 0%, sometimes even negative. Okay, so if big banks, institutions, hedge funds, and institutions were borrowing Japanese yen and doing this leverage type of trade. Hey, we're going to borrow in yen, convert to dollars, buy treasury yields that are paying out, US treasuries that are paying out 4%, right? And just make money on the spread. Well, that trade didn't work anymore once the Japanese yields started going up. In fact, when they hit about 1.1% here, this is when we had that Japanese yen carry trade crash, and which caused yields to come back down. Okay. And then they started creeping back up again. Then we had the tariffs crash, which caused the yields to go back in line. But right now, Japanese yields are at all-time highs. So potentially, institutions may be unwinding the second half of that trade, which definitely could be happening, could not be, doesn't matter. In the short term, yes, but in the long term, no. And I'm going to be getting into why exactly this doesn't matter in the long term, because I think the market's going a lot higher from here. Now, today, New York Fed President Williams says he sees room for a further rate cut or a further adjustment, and he's going to bring it up to Jerome Powell. So that really saved the markets today from continuing this downward pressure. Short term, yes, he definitely helped today, but that really helped on the CME FedWatch tool. So if we take a look at the CME FedWatch tool, which is the futures for rate cuts, the odds of a December rate cut are back on the table. And in fact, it's not just 55%. It's not just 65%. 71.5% odds that we get a rate cut in December, which is extremely bullish for the markets. And I'm surprised the markets didn't rally even more today. Okay, so, and it also increased the rate cut odds for January 2026 to 97.5%. So this is exactly what I want to be seeing if I have a bullish portfolio, and that I'm also entering new trades right now as the market's coming down, okay? So another thing to notate is that the quantitative tightening program is ending on December 1st, meaning that usually the Federal Reserve will just let the US Treasury bonds on their balance sheet expire and they won't buy new ones, okay? But now they're going to be ending that program and potentially start quantitative easing, meaning they're going to be buying US Treasury bonds. And when they buy US Treasury bonds, causes bond prices to go up and yields to come down and interest rates to come down. So as you can see, the forecast in 2026, they are going to have more Treasury bonds on their balance sheet. So what does that mean? Well, that affects the 10-year Treasury yield, which is basically interest rates, drastically. Okay, so we're already at 4% here on the 10-year Treasury yield. And my expectation is that these yields are going to come down to 3%. So what that means is that interest rates are going to be lower. People can borrow at cheaper rates, and people that have money in bonds aren't going to be seeking bonds anymore because the yields are too low, right? Barely beating inflation. They're going to be seeking riskier assets such as stocks and real estate, okay? So that's my expectation there. So long-term, 2026, 2027, I'm very bullish. If we saw, when they started doing quantitative easing back in 2009 after the financial crisis, right, we had one of the longest bull runs in history because yields just kept going down and down and down and down all the way to COVID 2020 when yields were literally almost zero, okay? So with that being said, I am bullish long-term, and there's a few plays that I want to enter, even though I did a hedge position today, which I will go over as well. Another thing that's going to fuel this is the M2 money supply. So money right? In circulation, 22.2 trillion. And the next data release is November 25th, which is next week. So we're going to see how much money is being printed next week for October, which is huge, all right? Because the most money in history is in circulation right now, sitting on the sidelines and ready to chase assets. And that's what we want to see, because when they increase money supply, that money has to chase assets, because the US dollar is being devalued day after day after day as they print more money, okay? So with that being said, I did do a bearish trade on QQQ today, which was a hedge for the portfolio, just because, the portfolio is a decent size here. And I said, hey, my outlook on QQQ is that we're not quite done with this pullback yet. I'm actually short-term bearish here, long-term bullish. So for the short term, I said, hey, why don't we put on a hedge position for the holidays that, hey, if it doesn't work out, cool, doesn't matter. We financed it with premiums that were collected for December. So I'm selling options for December, going to collect anywhere from 45 to 60K in premiums. So I said, why don't I take close to 10K of those premiums and do a bearish trade, so that if it does go down, I'm risking 1 to make 2.5. And that's kind of my outlook here. So I think that QQQ, especially after today's action, it definitely wasn't bullish. I said QQQ has to get above 600 and finish there today for us to resume an upward trend, and that did not happen. So I think that Monday, Tuesday, who knows, for the next few days next week, we can roll down. The faster we go, the better, because that would be the faster for rebound. So I think we could flow all the way down to 571. So with that being said, that would be a nice 10% pullback if we take a look at that, right? A nice healthy correction to shake out all the weak hands, shake out all the margin, all the leverage players, right? And really just kind of reset things for a nice Christmas rally. So it looks like we are getting that. And, of course, we could head higher next week, and this whole, me kind of predicting the market going down 10% could not happen. But I'm making a prediction that this could happen. So I'm taking the necessary action, okay? So again, 571 is what I'm eyeing. If we dip slightly below that, that's fine because of this hedge position. So let me show you exactly what I did. Again, VIX cash allocation levels too. I'm definitely way more on the conservative side right now. So VIX is currently trading at 23. It was trading at as high as 27 today. And if we take a look at the VIX cash allocation levels, essentially we are in VIX 25 to 30, which is very fearful. I could have 5 to 10% cash on the sidelines. Now, right now I have about 25% because I'm slowly starting to allocate every single day. Hey, it's, another red day, allocate more, another red day, allocate more. Instead of just going all in at once, I'm doing a slower approach, for you and for my group, Options Trading University, just so that, we can get as good of entries as possible. We can't time a bottom. And then if this market starts rallying back up, that's fine too. We could just allocate the rest. So, definitely more on the conservative side here, but essentially next week, I would like to get my cash levels down closer to that 10%. If we could remain VIX above 25, I'm thinking next week, we get a nice flush, maybe VIX above 30, 32 and a half, somewhere around here. And that would kind of mark a bottom. Okay. So that's my expectation there. So I think we're going to head down, bounce off that 571, and then resume for a nice Christmas rally, potentially even by January 1, being close to these all-time highs around the 630 area on QQQ. So that's kind of the expectation there. So the strategy we did, I'm going to build it out on option strat for the video. It was a bear call spread, a bear put spread, which is a debit spread, meaning instead of just buying a put option, I wanted to buy something that also benefited from time decay, so it didn't decay as fast, because I don't want to pay for an option that's going to decay away very quick and then I lose all my money, right? So what I did was I did the 580, 565, okay, I believe. Actually, let's go into the portfolio. Remember, this is not financial advice. I'm just sharing what I'm personally doing for educational purposes only. Results may vary, but if we take a look at the QQQ spread, yeah, it's a 575, 560 put, okay? So we're gonna go, I went January 30th, 575, 560. Basically, right now, a net debit would be per contract would be $400 to make 1,100. So it's almost a 1-to-3, risk 1, make 3. But by the time I was in it, it was risk 1, make 2.5. So good risk to reward, kind of at this level where I think we're going to go to 575 to 560. You know, if we overshoot the 571 area, boom, it's going to be down here near that 560. My spread's going to be totally in the money. And, you know, just looking at the profit chart, you know, we'd be in a decently nice profit there. So this is a wonderful strategy builder to kind of see how much you can make. But potential, you know, we could move this to, I did 20 contracts, right? So we can see exactly how much I would be making. There we go, exit out of there. Yeah, 22 grand. So pretty good risk to reward, 22 grand. I put up 8 grand. And right now the current trade is down about 3%. It was up about 4% at one moment when QQQ went down to 589. So we'll see. We'll see next week if we continue the sell-off. This will help kind of hedge the portfolio for a potential 20 grand profit there. So that is going to be my QQQ trade. But long-term, again, very bullish, and I just showed you the reasons why. So let's talk about the specific stocks that I'm going to talk about 3 specific stocks that I'm really loading the boats on right now. Number 1 is IREN. Okay, IREN. Look at the PE ratio, 21. All right, we're well below the lower Bollinger Band. We've breached this thing multiple times now. So right now, I just think it's at oversold levels. Obviously, RSI is showing almost oversold. So we could head down, you know, potentially at the lowest, maybe 38, 37, if the market dipped further. But I think right now is a wonderful time to sell cash secured puts. So let's dive into the portfolio. You see, I got assigned 1,000 shares of IREN at $52. I sold the 54 covered call to collect about 2K, and I get some appreciation there. So it's a wonderful stock to trade. But right now, if I add to the position on Monday, I'll go out to the end of December, and I most likely will choose, you know, somewhere around a 10% gain. So I'll choose a 35 strike, collect 300 to $350, which is a potential 10% ROI there. So in 35 days, obviously results vary based off of where the stock trades, but I really like that trade. That would lower my cost basis, and it seems like a great trade overall long-term. So that's IREN. Another one I've been adding, STX, Seagate Technologies. So what I love about Seagate, I know the company well, right? I use their hard drives, their external hard drives. It's a pretty boring and easy company to understand, and that's what I love about trading options. I trade options on good quality stocks with good PE ratios. PE ratios at 30, being an AI play, that's extremely low, and the chart is beautiful. Look at this chart, beautiful upward trend. We briefly almost touched the lower Bollinger Band today, and I added some more puts. So right now I think is a great put opportunity for STX. If you look, I have another portfolio that I added more to as well, but right now in this portfolio, we have 2 December 26, 215 put options to collect about 2,100. But again, if I were to take the trade over, I would go here, and I'd probably go for the same exact ones. I like the 215, collect $1,000, which is a potential, you know, near 5% ROI. Results vary based off where the stock's at. But 215 is great because, you know, it's below the lower Bollinger Band, so we'd get the stock down here. If the stock did fall down there, I'd be forced to buy 100 shares by expiration, or on expiration if it went below. But, you know, from current prices, that's about a 9% discount. And from all-time highs, that's about a 27% discount. So very wonderful discount on a quality company in a bull market. So that is exactly the trades that I look for. So STX is one of those companies, a brand new one I added to the portfolio last week, and I'm really liking it here. Now let's talk about the big trade, okay? The big trade is gonna be one that I show live in the group in Options Trading University once I take it, okay? Obviously the leaps are so I'm gonna be doing a leaps call option on this. And I share that live in the group. So if you want to see it live with me and you want to participate live, that will be in the group. Top link down below to apply. So what I'm looking for is it briefly touched the area today, but I'm looking for a nice, 143 to 145 on Palantir, which is right above the 200-day moving average. And we might just get that. If QQQ flushes to 571, that could potentially push Palantir down in these levels. And these levels are ones that we haven't seen since August of, this summer, right? And then before that, like right after we rebounded from the tariffs crash. PE ratio is currently at 362, which we haven't seen at this low since the tariffs crash, right? Literally at the bottom of the tariffs crash, we haven't seen it this low. So right now is showing great value for purchasing this company. Yes, PE ratio is high relative to other stocks, but for this particular stock being more of a unicorn, 362 PE is pretty low. I've seen this thing as high as 700. So if I could get this stock here, I'm going to be purchasing LEAPS options with a pretty sizable position. So, something like that would look like, and we'll just go to the position. You could already see my current cash secured put and stock position is near 200 grand. But, I'd go out far enough in time, somewhere like Jan 15th, 2027s are still good. And I just go 70 delta. So right now, 70 delta would be 140, but the strike will probably be different by the time I do it. So that's going to be my majorly bullish trade, kind of turnaround trade. And these ones I will hold for longer. So once we enter, sure, if the stock falls a little bit more, that's fine. Can't call the bottoms here. But once it rebounds, it tends to do this V-shaped recovery like it did here back during the tariffs crash. And I'll hold it until we get to these levels like 190, 185, somewhere around there. People that were purchasing the LEAPS down here made near a double, right? They nearly doubled, just from this recovery alone, let alone the stock went up even more from there. So really eyeing this area, the 143 to 145 on Palantir. And that's going to conclude the trade. So hopefully you enjoyed this update. Hopefully it bring you a little bit of peace of mind during these volatile times when most people are just doom and gloom. There are some good things ahead of us when we do get these nice corrections. So I hope you enjoyed it. Please give it a thumbs up. I'll see you in the next one. Take care.